Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his surprise guest that I highlighted on the daily financial news this morning, Mr. Jeb Smith. How you doing, sir?
I am well. Thanks for having me again. I appreciate it, man. Like being
Absolutely.
here.
Thank you for coming back. Thank you for bringing all the knowledge. I think we just got to start with the Southern California market. How did 2021 end up, and what kind of nuttiness are we seeing in 2022? Because I think it's pretty crazy.
Yeah, I mean, I think most people kind of know how 2021 went, right? I mean, it was crazy spring market, slowed a little bit down there in the summer and kind of sped back up in the fall, which was, I think, surprising to a lot of people. I don't think anybody expected the fall to be quite so crazy after coming out of the spring that we saw. And we ended the year at record low inventory, which is to be expected, but considerably lower than I think anyone has ever seen since they really started following inventory levels.
Yeah.
And we started the year with that number, right? I think we here in Southern California, we started somewhere around 900 or so homes on the market, like 920 or something here in Orange County, 3.3 million people, 900 homes on the market. Wow. Unheard of. Since then we've built a little bit. I think the highest number I've seen so far is about 1350. But as of today, we're sitting just in the low 1200s. So we've kind of pulled back a little bit. My local market, similar story, right? We started the year at about 60, I think 69 homes, got to about 110, 115. And yesterday when I looked, we were in the low 90s. So inventory is low. Demand is stupid. I mean, it's the things that I'm seeing. I'm very bullish. Right. I think anybody that watches my channel knows I'm bullish on housing, more long term than necessarily the short term. I don't really think in terms of short term, but long term, I'm bullish. I'm starting to get worried a bit just how quickly things are moving. I mean, it's, we saw 20% last year. I've seen easily 10% in the first month and a half of this year above price levels. And inventory is not picking up. So I don't, rates are rising, but demand hasn't dropped off yet.
Yeah. So this is what I want to talk about. Cause again, you've been in the business doing this a long time. We both have seen lots of stuff. One thing I now believe, because I've been tracking the consumer for 30 years and the real estate market for just over 20. What I think happened, and I'd love to see if Orange County was the same. So we had this, the summer months were what they were last year. Then then people got, hey, we beat this thing. Let's go out on vacation. Then they stopped looking. Right. Then the holidays came. Then lo and behold, we flip over the calendar year and seemingly out of nowhere, but if you've been watching both our channels, you knew this was coming, rates rose. Right. So as rates went from 2.75 to now 4, right? They're already over 4. What we're seeing is all of those buyers who were on the sidelines go, holy blank. Yeah. We need to buy right now. So I think we are in just a hyper nutty Q1, maybe to the middle of May market as these people who didn't buy last year buy, because pretty soon they could be priced out when rates and prices go. What do you think of that?
I agree with that 100%. Yeah. I mean, I don't disagree at all. I think that's very much the driver. And the lack of supply. I mean, it also comes with the lack of supply, right? If there were a ton of homes out there, people wouldn't have to do the craziness of the overbidding. And that's, before we came on here, I told you, I mean, we had a minute to talk and I said, I just listed a property for $850 here in a popular city here in Orange County. And it was priced right. I mean, it's where it should have been priced. And it sold, we had 22 offers and it sold for over $1,050,000. That's $200,000 above the asking price. And if you do the math on an $850,000 home, it's roughly 25%, pretty close to it.
That's so unhealthy.
It's just stupid. It is not good. But here's the thing, out of 22 offers, let's talk about that. Cause I think this is important. Out of 22 offers, I haven't done the calculations and I'm going to do a video on this, but I would say 75% of those people waived the appraisal. Okay. Most, in fact, all were above the asking price. Many of them were at least $100,000. I would say out of 22 offers, at least 11 people were $100,000 or more higher than that.
Wow.
We did have one FHA offer at 3.5% down. Everything else aside from that offer was at least 10, but many were 20, 30, 40, 50% down. So there was a lot of money there and many were cash.
Yeah, so that's what I was going to. How many were cash?
I don't know the number right off the top of my head, but I would say probably 3, maybe
Okay.
4.
All right.
So a decent portion of them are cash. So you've got to
Yeah.
think, I mean, those are people that market adjust rates, they're unaffected
Not affected
entirely, right?
entirely.
At all.
Yeah.
And
Yeah.
so those are still buyers, but are they buyers when that sets a new comp or pretty close,
Yeah.
changes the values in that market? Yeah.
Yeah. It's again, we're dealing with big numbers, right? You're dealing in Orange County. I live in the Bay Area.
Yep.
Our starter homes are 1.3, right?
Yeah.
Where I live. Same kind of nuttiness. So when I look at this situation, 22 offers. Now you have a new comp at, $1,050,000. And rates go up. That's, that payment. So that probably knocks the FHA buyer out because they no longer qualify, right? 3.5%.
Absolutely. I would, yeah, 100%.
So let's say of the 22, 4 people are out because they can't buy now at the new price or new rate.
Mm-hmm.
That still leaves 18 qualified buyers who had 20 to 50% down or cash to buy somewhere else, right? So it's, as this thing goes up and we pull forward appreciation, we are going to see less buyers, but it's not going to be, you're not going to go from 22 to 2. It's going to go 22 to 11 or something like that.
Right. And I guess my concern is just the lack of, I mean, I thought inventory would pick up by now. I really did. But I've started to, these are conversations that I'm having with a lot of smart people because I want to hear the other side. I don't want to just believe I'm bullish, but I don't want to believe that my side's the only view. Right. So start talking to people and, that run hedge funds. I have some friends that run a fund out in the East Coast, and we're having these conversations about rates and all of these other things. And some of these people are in a similar position to me, is where they would like to buy another house. Families are growing. They're not in a position where they have to do anything. And they're looking at this price point that they're now in, seeing homes that are in that price point, but that they need $300,000-$400,000 worth of work just to make them livable. And not only that, your tax, like here, fortunately in California, because of Prop 13, your taxes go up, you're paying a higher rate, a higher price. And you start to look at it going, do I really need to move? I mean, and at the same time, like, are you going to sell your home? I mean, that's the thing, is like, I think as rates rise, not only does it affect buyers not being able to buy, I think sellers look at that and go, I'm no longer a seller either, because I'm not going to buy. I'm not going to pay 1% higher in rate than I have on my primary home to buy a more expensive house. It just doesn't make sense. So I think it's going to affect inventory both ways.
Well, that is very interesting, because I was going to get here later, but let's go there now. I actually think one of the things that may happen is we may see transactions fall this year, which I don't think a lot of people are calling for, just for that reason, right? Let's just say, because for 40 years, it was common to have a first-time home, then you'd have a move-up home, you'd sell your home and you move up, and then you'd have a move up to luxury, right? That's just kind of but also rates were going down for 40 years. So yes, you bought a more expensive home, but your rate went down, and sometimes your payment didn't really change.
Nope.
Because you have right? But now, let's say we have 4 or 5 years of rising rates. Nothing crazy, but they tick up for 4 or 5 years. Are you really going to trade that sub 3 30-year fixed rate loan for something in the 4s and sign up for another $200,000 or $300,000, $400,000? I don't think so. I think transactions really could slow down.
I agree. Yeah, I mean, I think for sure less transactions this year than last year, right? The question is how many, right? I've read smart people that think that, that come summer, the market slows down and inventory really starts to build in the August, September, October market.
Yeah.
I hope that's the case. I mean, everybody thinks because I'm a real estate agent, I want to see this crazy appreciation. And the reality is I don't. I'd love to see a more balanced market. I mean, it's frustrating. I mean, everybody's like, agents have it the best. You guys are just making money hand over fist. I'm working 10 times as hard to make half the money because I'm submitting offer after offer after offer on things that I probably know now because of what I saw yesterday. I have no chance. I mean, It's the reality. So it's frustrating, but
the other thing I want to be very clear, get on record is somebody owns a bunch of properties. You might think I would love to see year after year of 20% appreciation. I promise you one thing, I do not. That is a sign of an unhealthy market. And I've lived through this before, and I know what's on the other side of 3 years of 20% appreciation. It's not good. So no, I don't want it either. I definitely want a housing. So I've been calling a housing slowdown. You and I talked 4 or 5 months ago. Yep. I thought it would happen heading into last year. I felt good. until rates went up and suddenly everybody came off the sidelines. I'm like, oh, there goes the slowdown. It's gonna be crazy. So
I just don't know how far rates can really rise. I mean, that is my thing. The Treasury, $31 trillion in debt. It's a debt service. We don't have the money to pay our current obligations as it speaks. We go bank, we have to extend the debt ceiling every 2 months because we've reached it. Right. And so how far can we really let rates go to the point where, one, it affects the big money, right? The stock market. Yeah. Because let's be honest, there's influence there.
Oh, no question.
It's an election year. Nobody really wants to do anything crazy in an election year. So I just think there's some factors that, while they really shouldn't be factors at the end of the day, they are, because there's politics. There's things involved that you and I aren't involved in. We don't really probably know the half of it, what goes on behind closed doors, but that's really what happens. I mean, doesn't mean it's good, but it is taking place, and those are conversations being had.
Yeah. The other thing I want to talk about with you is kind of, I want to play a little what if game. And the first one will be, you brought up rates. We'll make the first one rates. So I believe we are in a rising rate environment, but really what impacts real estate is the speed. For example, if we go today, I heard that last week I talked to the mortgage broker, the average rate was 4.03. If we go from, say, 4% to 6% by October, my opinion is the real estate transactions fall off a cliff and we slow down very quickly. If we go from 4% to 6% by summer of 2024, there's not really an impact. People adjust, it's all of that. So for me, I think it's the rate of change versus kind of some peak and some trough. How does that feel?
I mean, I agree with the first part. I mean, I think if rates went from 4 to 6, the housing market pulls back 20% more. Probably, I mean, it's going to pull back considerably. Now, if rates go 4 to 6 and it still takes 2024, I still think you see a big decline. It just slows down. I mean, rates are a key driver. I mean, it's many of the buyers in the market at the moment haven't seen high rates for the most part.
Dude, high rates for them are 4.
Well, I mean, I guess that's not the, a lot of, let's say half the buyers have seen rates in 20% range, right? I mean, at some point, right? The boomers and those people, and they're still buyers in the market to some extent, but a lot of the millennials, a lot of the move up buyers that have the equity, the cash that they've gained over the last 3 to 4 years, those are making up a good portion of the buyers at the moment. Those people haven't seen rates at 6, 7%. Right. I mean, a lot of the 6 and 7% that we saw, even when I was doing real estate and mortgages, actually during that time, were interest only. Most people were doing interest only loans then. So you didn't even see the full 6 and 7% because you were only paying the interest on the loan. You weren't even paying the principal.
I remember.
So that could affect the market considerably. Now, I personally don't think we can go there. I don't think, but that's my opinion, right? I mean, that's the great thing about these conversations is that, you hear both sides.
Absolutely. Yeah. I'm not calling it for to go to 6. Yeah. I was trying to highlight, in my opinion, I actually think if we go to 4 to 6% and it's a slow and gradual 24, 30 month thing, not really impactful because people adjust to that. They have a little bit more savings, but who knows? Right. But if we go right from 4 to 6 over a weekend or something, like Powell comes out and says, whatever, that real estate stops. We just, it falls off a cliff. So the next thing I wanted to talk to you about, because we've been doing this so long together, is a recession. First and foremost, recessions are natural. They're part of the business cycle. Yep. We will have them again. I personally think we will likely have one that starts this year. So if we were to have a recession, and let's say the unemployment goes from 4 to 8%, does that impact housing at all, in your opinion?
I mean, I think it depends on, I think that is coupled with rates. A recession itself, right? I think a recession 100% is going to happen. It's very likely that it's going to happen later this year. If not, in the next year, year and a half for sure. I mean, you've
For
got
sure, yeah.
you got the 2-year and the 10-year about to
Yeah.
we're about to have an inverted yield curve, which essentially signals a recession about 2 years out is historically what happens, right?
Yep.
So within the next 2 years, in theory, you're going to have some sort of thing.
Yep.
So if that's the case, inflation obviously is going to be less of a concern. Then people's fixed payments, I think, less of a concern. I think here's the thing. Recession, I think a lot of the wealthy, the people with money, still probably continue to buy assets, buy real estate, that sort of thing. It's the people that are on the lower end of the income spectrum, the people that have received a lot of the money from stimulus and that sort of. I think those are the people that are most affected. So I don't really know how many of those people are buyers to begin with, but I think it affects more of the lower end of the financial curve, if you will, than the high end. But I home prices, I think, I don't know whether it affects them or not. I mean, I think it really depends on what happens to rates. If rates stay low, I think there's still a lot of cash in the system that's not going to go away. I mean, the average homeowner has $185,000 in tappable equity. And what they consider tappable equity is you have at least 20% in your property, and then anything on top of that is tappable, right? And so there's 9.9 trillion. That's a T of equity in the system. So there's a lot of money out there, not counting the pension funds, not counting the iBuyers, not counting these other things. So again, I've told you I'm bullish on housing. That is what I look at and think, okay, how does that dynamic change? Because that part starts to confuse me. I mean, for me, affordability is more the concern than anything else. If you told me that, we were still that wage growth is growing, right? Because a lot of the people aren't willing to work for $8 an hour now or $10 an hour. There's people hiring everywhere. In fact, I just came back from North Carolina. That's where I'm from. Eastern North Carolina, small town, middle America. I mean, this is like podunk stuff. And, family owns restaurants and that sort of thing. He's like, they own a small restaurant. They can only be open 3 days a week because they don't have enough workers to actually work 6 days a week. And he's talking to me. He said, look, I hired 3 people that didn't even show up. Like they were hired. They didn't show up on day one. Because I can't get people to work. So, I think about that sort of thing and go, okay, I don't know. I mean, there's just so many factors playing into it.
Yeah, it's definitely all about affordability. It's always been to me. I've sold stuff in 2006 because of affordability, and my market got to a record low. I think that's the thing everybody should track. So dead on there. For me, a recession is what happens, because I've experienced a couple while being an investor, right? There was the .com crash,
right,
which hurt the Bay Area a lot more than most regions. It stopped our market because, again, it's all fear-based, right? If you are afraid your .com company is going to go out of business tomorrow, that's a problem. You're in Southern California now. You were obviously impacted a lot by the Great Recession because a lot of the mortgage, like New Century and Countrywide,
they were all here.
They were all there. So, right, if it's very regionalized, right, and people are afraid, the market will slow down or stop for sure, because signing up for a mortgage is, for most people, the biggest expense they will ever have. And if you're afraid, you just don't do it. So really, it's about the recession. Where is it? Is it industry specific? All those things for me. So that's what I think about recessions. So we look at the market going forward. I'm curious, have you seen the return of international buyers? Because I think that's coming, and you'll see it first, but I don't know if they're back yet.
Here's the thing is, like, the price points that I mostly serve, and for many people out there, they're going to think this is crazy, but I don't serve the higher end, right? I don't serve like super luxury stuff. I mean, I'll sell a $2 million house here and there, but to me, that's, for where I am, is not, it is high end. And that's what I say. People think I'm crazy, but it's not like high end in Orange County.
Like high end.
Right. I mean, there's 8, 10, 20, 30, 40, $50 million properties here. Right. So what my experience, a lot of that money likes to park their money in higher, nicer luxury property, at least historically. And so, I know that market's still moving. I have friends that sell a lot in the higher price point markets, and they're basically saying, look, there's no inventory. Like, I have you
Just
know,
no inventory.
I have buyers that we can't find property.
Mm.
In fact, one of the reports that I subscribe to, demand was down like, I don't know, 20% or something on the luxury end. But then you looked at listings were down in the luxury end by like 50%.
I
And
saw
so
that. Yeah.
you look at it and you go, okay, demand's down clearly because there's just less
There's
property to
nothing
buy.
there. Yeah.
It's not down because there's nobody willing to do it,
Yeah.
because the big money is trying to find that fixed asset, especially in an inflationary environment. And so
Totally agree.
yeah. So I haven't seen it, but I do think, I mean, that is a possibility that you see that money come back in, because they haven't been able to travel. They haven't been able to buy in this. And we don't even have to talk about like international, saying, Asia or some of these big markets. I'm like Canada. Like Canada's a big buyer of
It is.
US real estate in the desert, the warmer areas, because they like to vacation there half the year.
Yeah.
And they haven't been, they've
Snowbirds.
been on full lockdown for literally 2 years. They haven't, it's a pain, in the butt to leave Canada. So I think
Yeah.
that money does
It's
start
coming.
to flow in here, but at what price? I mean, are the, and that's the thing, is like Canadian prices are way high. They've all like, their market it makes ours look silly because of the appreciation. But to me, it's like, it's starting to become, how many times can you see that this crazy growth and not get surprised? I tell everybody every day, I'm like, I do this for a living, and every day I'm surprised. I'm like, wow, really? Somebody did that. Okay. Well,
Yeah.
guess but the next one surprises me as much. So
Wow. So the next thing I want to do is I want to pivot to the first time home buyer. I personally think, in my 21 years of buying rental properties and watching the real estate market, this is without question the worst or hardest, or whatever you want to call it, market to be a first time home buyer. That FHA buyer you talked about in year 22,
yep.
I feel for them. It's
agreed.
nearly impossible.
It is. And I mean, people don't understand how important the first time home buyer is to the market, because the move up buyer can't buy the move up home in most cases unless the first time home buyer reaches in and buys that entry level home. Now, it doesn't always work to that scale, but that's typically what happens, right? The first time home buyer comes in, buys the lower priced home. The lower priced home moves up to the mid priced home. Mid price moves up to maybe a little bit bigger, or the luxury, or whatever. Without that first time home buyer, you don't have the person to buy the entry level that allows the transactions to take place, or that cycle to happen. And so it's important that there are properties for them. Now, in some areas of the country, it is still affordable. Here in Southern California, it is clearly not. And in your market, it clearly is not. So that is worrisome. I mean, it is, I talk to first time home buyers all day long. In fact, I have a couple that I'm working with now, and it takes some time to get them with the idea of what they need to do. And it's, we're almost, instead of giving them the advice of writing way over and this sort of thing up front, or waiving contingencies, like, hey, listen, I want you to write the offer that you think you need to write. Let's just see what happens. And then, don't take my word. Let's just see what happens when you write the offer that you think is a good offer in this market. And let's see what happens, because that gives them more clarity than me giving them advice of saying, hey, look, this is what I'm seeing. This is what I'm doing with other buyers. Because it's like, whoa, I've got to go in and I've got to waive my appraisal. Well, what happens when I do that? Well, I don't have the money for that. It's all of these things. And those are things that you have to worry about as a first time. You should have those concerns. So it's not like I can discount those concerns, because it's important. And my job as a real estate agent, as a broker, almost as a fiduciary, if you will, is to guide these people and give them, the best advice I can. But also my job is to help them get a home. And so there's a balance there that's very difficult at the moment.
Yeah. I certainly hope it gets easier in the summertime, when inventory kind of balances out. We wash out all the last year buyers who didn't buy, but we'll see. It's
agreed.
so hard. It's so hard for first time home buyers. The other thing I wanted to ask you about, we saw, again, I talk with a Las Vegas broker, Brian Lebo, all the time about what's going on there. And he is saying he's seeing a lot of Orange County money leaving Orange County and moving to Vegas for tax reasons or politics or weather or whatever. Are you seeing any of that kind of where you
Yeah.
are? Like, okay, let's talk.
Yeah. I mean, I think it's for many reasons. Like you said, it's taxes, it's politics, it's people just sick of the home prices and looking at markets going, hey, you know what? I don't really want to be hot as hell 5 months out of the year, but I could buy a really nice house and
I can buy a couple of ACs.
Yeah,
I'll be good.
exactly. I mean, and so I mean, you've even seen, like some of the bigger YouTubers out there post about moving to Vegas, and it's mainly due with taxes and again, politics, but the reality is it is happening, but don't let that fool people, right? People see the migration patterns and they're thinking, oh, everybody's moving from California, real estate's going to drop. I mean, the numbers would have to be considerably higher than they are now to have any effect on real estate. And I think that's important to note is it's the net migration. It's not people moving out of state. There are also people moving in. So there's a number there that, that you have to add and subtract to get to the net number. And the net number is not anywhere close to where it would be to have an effect.
Yeah, I totally agree with that.
Yeah.
And the last thing I want to talk about is how do you feel about because again, you have a mortgage background. How do you feel about people coming to you and going, hey, I got all this equity in my house. I want to go take a home equity line of credit out, and I'm going to use that debt to buy an investment property. Maybe in Southern California, maybe out of state, who knows? But I'm going to go pull 200 grand off my house right now, and I'm going to go buy some investment property. I know there's lots of questions you have, but generally speaking, do you like that idea?
So I literally just did a video on this last Friday. It posted. So if you guys want to really, I mean, I dive into it in more detail, but it is the things you have to consider. For everyone, I mean, it's not a bad thing for everyone. I will say that, right? I mean, so for every 100,000 you pull out of your house, it's about $500. So 500 added to your payment. So if you can go buy property in a market in California, it would be very difficult to put $200,000 to work, right? You're not going to buy anything that really makes sense. But if you go into some of these markets that have great employment, the growth of people in that area is going up, and good jobs and all of that stuff. And there's a lot of markets out there you can put 20% down, 30% down on a property, and it cash flows.
Yeah.
And if you can get into the mindset where, hey, listen, you're probably not going to get the appreciation that you do in California. It's going to be worth the same price in 30 years as what you paid for it now.
Yeah.
But you might own a piece of real estate that, long term can generate some cash flow. I'm okay as long as you have everything else in place. As long as you have money in the bank and you set yourself up. Now, if that's the only thing you have and you're literally maxing yourself out on your mortgage to pay that additional 200 that you're pulling out, and you barely have enough to make it meet on this side if the property's vacant or what, no, don't do it.
Yes.
But like if you have, I'm sitting on a lot of equity at the moment. Fortunately, I have cash, right? So I'm actually looking at some of these markets at the moment and buying some investment property because I can put, I can buy in the example I use in that video, the properties that I'm looking at are somewhere between like 200 and 240.
Okay.
They rent between $16.95 and $18.95 a month.
Yeah.
It makes sense to me. My payment would be just over $1,000. I'd make about $695 a month. I'd take that $695, I'd put it right back into the property, I'd pay down the principal. Eventually that property be paid off in probably 10, 15 years. And it'd be a cash flow. I mean,
there you go.
To me, that makes sense. But I don't think putting yourself in a financial position, a strain on one side to generate a little bit of cash flow, because, that's the term to, your way to long-term wealth or growth or whatever. No, don't do it. And don't be a serial refi-ist, if you will. Like, don't be the person that refis and pulls cash out every single time the market goes up, because there's problems with that.
I totally agree.
Yeah.
I love the fact we're both very cautious. We've been through the last crisis, and I don't like maximum leverage. In fact, it freaks me out. I generally tell people I would never add debt to where my wife and daughter sleep. Like, nope, I'll find another way. But you're right. If there are some ways and you have the reserves, okay. But for a lot of people, the answer is no. For a lot of you listening, the answer is no. Leave the money there. Do something else. So
there are, again, there are better ways to leverage yourself than through your real estate, in my opinion. So
absolutely. Well, Jeb, you do an amazing job on YouTube. You're putting out great stuff. You just referenced the video. Where can people find you?
So just search my name on YouTube, Jeb, J-E-B Smith. That's the best place. From there, you can get all the other stuff, but that's where I update people a couple times a week, do a live on Wednesday. So if you ever want questions answered, that sort of thing, you can tune into that as well.
What time on Wednesdays?
5 p.m. Pacific Standard. So I do it for 2 hours.
Wow.
96 hours I did last year on that thing, 48 times, man. I was like, I
I
added it up at the end of the year. I was like, what did I do? Holy cow.
That's
But
amazing.
it's-
So
yeah,
5
it's
p.m.
all good.
Wednesdays, 2
Yep.
hours. That's amazing. I do 1 hour on Saturday morning at 8, and that's enough for me. 2 hours. My voice
I
would
think
hurt.
that's good. No, it is. I mean, I have someone on there most of the time, like my lender, and we bounce back and forth.
Okay.
Yeah,
okay.
I've tried to do it by myself, and I literally am losing my voice by the
Yeah,
end of it.
that's crazy.
Yeah.
Well, Jeb, keep being awesome. Thank you for doing all you
Appreciate
do.
it, buddy.
Have a wonderful day.
Thanks again.